Welcome back to the TD Ameritrade Network. We're looking at the NASDAQ opening bell in New York City. Bank of Princeton ringing the close. BPRN, the ticker, and the S&P 500 is going to fall short of a new high, 2862.82. Just a few points, though, as the S&P continues to make some moves to the upside after lagging the small caps, lagging the NASDAQ. The big caps are back, and this time without the help of Facebook, so you can't say it's all due to FANG. Uh-oh, bear theses in trouble. All right, the Dow also moving higher. There's the NASDAQ up 35 basis points, though a lot of discretionary behind that rally. Not to forget the small caps, because the rut also just jumped in a big way to a new high, 1.1%, as the Russell makes a comeback. And as we mentioned, pretty quiet in 10 years, and VIX sitting just below 13. Tech is mixed, but we're going to talk about some of the groups that made moves today after earnings and more. I want to continue our conversation, bringing the macro and the micro together. Bob Iaccino from Path Trading Partners is with us, as well as Christopher Recker as well from AZA Capital. We've also got Alex Coffey from TD Ameritrade here with us. Alex, before the break, we talked about the number one figure you're looking at this week, and home sales. I think it's an interesting point. Does it become more interesting after what we just saw from the home builders? I mean, we're starting to get some answers maybe about supply, demand, or where the problem is.
Yeah, I mean, one thing that's been the question with existing home sales is they've kind of blamed those bad numbers on inventory. And so I think it'll be interesting looking at it this week. Is that going to be the same story? But we look at home builders. You had Toll Brothers came out really strong today. And the interesting part there is I was like, okay, here's a luxury home builder that did really well. But then you dig deeper, the whole industry rallied a bit. So.
Yeah, ironically enough, Pulte Group managed to jump the most. And last time around, when Pulte Group reported, they got sold off. Toll Brothers today rallied. D.R. Horton rallied, which is basically kind of opposite end of the price spectrum as Toll Brothers. And you see now a story that's being told, or is it too hard to figure out at this point, Chris? Are you interested in this group? I mean, when you talk with clients, this is a place where you want to try and bet on a rebound?
I think it's ripe for a rebound, but I would say we're more concerned now at 2 years as the Fed continues to raise rates. Prices in homes go up. Affordability becomes an issue. We're not as concerned about inventories. We think that we have to look at the earnings power over time. But I would say you're looking at a Toll Brothers where forecast free cash flow is $700 million in 2020, and you have a $4 billion market cap. I mean, that becomes at some point becomes very, very priced in where it might be interesting. So I would say that the group is becoming interesting, but you have to see how Fed policy is going to if it's going to extend the cycle past 2020.
Well, my question about this is that I get that if mortgage rates start to climb, and they have been already, even with the 10-year flat, right? Sure. It's kind of, just because the 10-year is flat doesn't mean mortgage rates have been flat.
Right.
But that being said, relative to an old historical standard, they remain pretty low. You look at the backlog on something like Toll Brothers, and this is where I have some trouble with figuring out the catalyst for the group. Because if there's demand for homes to be built, a lot of these people have already paid the money for the homes. They're not yet built. Is your point then the market already understands this and is pricing them accordingly? Or do they just need to start building those homes and people will buy on the earnings that they show as a result?
I would say that the market understands the path of starts over time, or at least has some idea where it might go. And so right now, when you look at the path of Fed policy, I would expect to see maybe a peak in starts in 2 years.
Okay.
And so when you look at the path of free cash flow, that everybody values companies on a discounted cash flow basis, and Toll Brothers has a great balance sheet, a lot of assets. It has potential for a lot of growth over the next few years, but after that, it's an unknown how sustainable the housing cycle is. Mm-hmm. And so as we move into late cycle, if you look back into 2005 home builders again, they traded down sometimes to 5 times earnings, but they're at all-time highs. Mm. So I think you could see this type of dynamic play out again. And even back then, at 5, 6 times earnings, some of these stocks were great shorts. I'm not saying that these are shorts here, but I would say we have a much healthier type economy, and it's more balanced than it has been in the past. So that's what I would say is the market's thinking.
Bob, are you trading this group right now? Are you interested in this?
No.
How come?
For me, it's a little bit above my pay grade. There's too many moving parts in the home builders for me. There's interest rates, there's banks' willingness to lend, there's consumer credit scores, there's input prices in terms of basic materials. too many moving parts for me to kind of look at it and make a fair prediction. You could look at a balance sheet, you can look at a price chart, but there's just so many things that you have to kind of be good at. It's probably better that these two guys look at it, not me.
Alex, looking at this group, to come full circle here, because there's been a lot of hay made over what's happening to the home economic data, the housing data that we see, every week in the economy. And the question is whether or not it signals weak consumer and inability to be able to buy these new homes. But then Toll Brothers comes out, and guys, bring up those numbers again, because even though you have signed contracts growth slowing a bit, you've got deliveries increasing, you've got a backlog that's expanding, and a rate of cancellation that says people still feel good about their own outlook. Is this a bit of a chink in the armor for those that are drawing a bearish case from the housing data we've seen?
So there's a lot there, and I think he brought up a good point too, that this industry, or this entire sector, there's a lot to it. It's still been a pretty rough year for home builders. So I mean, like they had one pretty good day today. It's not like they're all the way back. They started significantly higher to begin the year. So I think a lot of those questions are still there. And one thing that I find interesting too, as you brought up, you got raising rates, you got raising home prices. Maybe you look to home improvement. Maybe you're not looking out there for buying another home. Maybe you're looking to, go to Lowe's or Home Depot, buy some stuff and put some work into your home.
That's been a thesis behind some of that divergence, with Home Depot and Lowe's remaining a little bit more elevated than the rest of the pure home builders.
No, yeah, exactly. And I mean, we have Lowe's coming out this week too. I know Home Depot is strong. So I don't have the exact answer as to, is it just a sector rotation into a weak group, or is some of this data the reason? It's probably a combination of both, but it definitely was a weak sector and people are looking for value.
It's funny. I'm sorry, Chris, but we own Home Depot, and the whole point was pretty much what Alex said. We're looking at trying to profit from people trying to fill that inventory gap in the middle by buying lower end homes and flipping them and picking them up, which the data is showing that's been increasing. There's some danger there, obviously, but you combine Home Depot as a business, and then you combine that sort of gap that these people are trying to fill, and we like that stock for a while now.
It's more of kind of a retail play maybe than a necessarily a housing play?
It is, and again, that's kind of why I stay away from the home builders, because for me, I like things that the consumer can go out and pay for on a credit card. We don't have to worry about their credit to get, which is why, like I mentioned last week, I like value retail. But the Home Depot play is just that, people fixing up their own homes because there's no inventory for them to move into, and then people flipping homes trying to fill that inventory void, of which I also anecdotally know a lot of people doing that. So that just seemed like the right play for us.
Yeah, Chris?
Look, when it comes to housing and the retailers, I would just say, look, it's the cycle. Housing starts, for the first 6 months of the year, they're up 6.5% year over year. But we are starting to see some leveling out. And I think that has to be of some concern. And so the duration of this cycle is really the big question. We know the demographics are there. We know the income is there. We know tax reform effects are going to last for another 2 years. So beyond that, that's the big question.
That's a pretty long sort of assessment you guys have. There are a lot of folks out there that say, hey, next quarter, you're not going to see this bump.
Right.
So that is sort of I would say that's kind of an anti-consensus, a non-consensus view that you have, 2 years.
Right.
My question then, or go ahead, I mean, does this have an effect? Is it something like more dollars in consumers' pockets? Will it show up in housing? Will you start to question that if it doesn't?
Well, no, it should. Well, I think where you're seeing the dollar show up today is in with retailers. So these tax cuts, you were seeing a lot of very good consumer spending numbers. And so whether it's a total dollar spend is expanded, the share of that spend is going to retail, it appears. Whether or not it goes into these durables and housing products or in your budget is another question.
We look at what's happening here on the retail front. We saw Redbook, a pretty outstanding number, 4.7%. That's where we started this morning. And Alex, as we're sort of trying to connect the macro, housing picture and find pieces of evidence in the home builders data, it's kind of the same story where we're taking this macro story about consumer spending, looking at companies. To me, that it seems like it makes a little bit more sense so far, where everything lines up. A nice Redbook number, TJ Maxx pulls out good numbers. Kohl's makes an incredible intraday turnaround after what we said this morning seemed like pretty solid numbers across the board.
No, yeah, I agree. I think actually it's a good point. I actually think it is rotating more into, like you said, stuff that they can buy on a credit card, not necessarily something they're going in and they have to, get credit approved. They have to go and actually build this home, and it's a longer term investment. It's more that they're just buying things that they need at the time.
Yeah. Does it, that right there people have concerns about because they say, all right, well, that doesn't build wealth over time. We're kind of getting, you know, into a different realm here. But that being said, we're learning a bit about the consumer right now, Bob. It might be a different type of consumer than we've seen in other pockets of strength, economic strength before.
Yeah, I think it's an easier one for us to read, so to speak. I mean, you know, again, I hate to, I'm going to be repeating myself, but last week I talked about.
Welcome to the club, Bob.
Thank you, I appreciate that. It's warm in here. The Ross stores we bought a while back, ROST. We bought Aaron's. We bought these things that where when you see job numbers being consistently stronger, and you see the people that don't have jobs that come in. Yeah. What's that called again?
New entrance to labor.
Yeah, the labor, back into the labor force. You see those people are so excited to have a job again and have money again that one of the first things they go out and do is maybe buy some lower end things that they may not necessarily be the smartest thing to do, but we've seen it happen cycle after cycle after cycle, which is why we like the value retail. Turns out all retail is doing well apparently. Bricks and mortar, Target's expected to do well as well.
Yeah, just don't include L Brands on that.
No, don't include L Brands, right. But you know, it was a fairly predictable play. The only risk was the bricks and mortar factor, and would it all go to Amazon? Would it all go to Walmart? Walmart online also did better. So,
are you worried about the alpha coming out of that as more people learn that maybe this sector
out of
is
Amazon
dead?
Or out of that play?
Out of the retail play, which you maybe used to be value retail.
I think so. Amazon made headway by price cutting, and now they're starting to play on service. And if you look at it, they're not always the cheapest anymore. As a matter of fact, I found in our household, probably about 60-70% of the time, they're not necessarily cheapest. It's just a matter if we want it tomorrow or if we can wait 2 or 3 days. So now Amazon is trying to compete on service. And some of these stores, you can do better. And Kohl's, obviously you could return Amazon there, and that brings people into the stores as well. So it's not necessarily an experience thing, but they are getting people back in the stores, and I don't really know why. But it was, again, it was kind of predictable.
Yeah. Chris, when you look at the retail right now, is it a place where there is opportunity to invest because they're growing, their comp sales are going to continue increasing, or was this basically a sentiment play when a group got a narrative that was a little bit dire?
Right. So look, we made our investments in retail, you know, over the last year when this big sell-off, but we're still holding.
Okay.
We think it's a longer story, but I would say that we have to take into account the tax reform effects on spending. So I would say there are 3 things. One is Amazon is knocking out a lot of weaker players. That's, you know, the beneficiaries of that were definitely Kohl's, talking about Bonton.
Yeah.
Target's parts of theirs, they've had a lot of efforts that are improving performance, but that is helping their middle of their store. And then the tax reform. So those 3 things are really helping retail right now. And they're making, so all of these guys, again, we talked about new product offerings, new service offerings, and getting closer to your customer, but that's come at a price to margin.
Yeah.
So I think the next leg is going to be a margin story around gross margin and operating margin, and the question is, can they implement these things, invest in it, margin comes down, but then can they optimize and get back to a sustainable margin level in a stable industry? And I think that's the question for the long run. We think some players can do that, Target, Walmart.
Well, I was just about to say, that sounds like more of a competitive, it's sort of intra-sector competition where maybe they're not going to get destroyed by Amazon, but now they have to worry about whether or not people are going to go to Urban Outfitters or if they're going to go to Gap.
Yep.
So where right now do you see the most opportunity? Is it specialty retail? Is it the stores that are making a comeback like Kohl's that are big box?
Look, these things are fairly valued right now. I still think that Target has some room to run, but I would just focus. I think Walmart can go some more, but they've had big moves up. So I would let them digest it. Same thing with Kohl's. Kohl's is very interesting at $30, $40. Here, it's just, we've pretty much liquidated most of our positions. So I would just say it's.
So you might have liked it earlier this morning when it was dropping, Chris.
Yeah.
All right, we're going to have to keep waiting. Alex, give us a heads up. Target tomorrow. This is going to be a big one. You know, you can look at Walmart and say, all right, these stores are doing well, but Target's a little bit of a higher price point. Seems like Dollar Tree, Dollar General all reacted positively to Walmart's earnings. Target may be a little bit still out there in terms of the market's vote of confidence.
Right, so you took a little bit of the words out of my mouth on that, as they are different clientele, but one thing that Bob said I find interesting is this whole industry, you're seeing it from all different sides. It isn't just the Amazon effect anymore with the e-commerce sales up. And we actually saw that that's what Walmart kind of did. They went all in on that. and it actually has worked out really well. But Target took a different approach. They're still focusing on it, and they're blaming a little bit of their margin and stuff, like you said, on some of that investment. But they're hoping to have that stabilize. So I'm curious to see if that happens. But I'm also curious too. I mean, they've invested a ton in their brick and mortar stuff, and they've seen increased traffic. So does that
Target
continue?
effect?
Yeah, well, I would say it's a segment domination story in a lot of these. So TJ Maxx can get in and they can get lower prices than Amazon because they have relationships with, they can go to high-end Italian designers, whereas Target, they're not going to go with like a Parisian fashion house. They're going to go with Magnolia, Chip and Joanna Gaines, and their home and hearth type segment. And so I think they're really all catering to who their customers are, where they really specialize, and it's tougher for an Amazon to hit all those notes.
Right. Who is Target's biggest competition the way you see it, Chris?
Well, I mean, I would say Walmart and Amazon. I would say Amazon should still be their biggest concern.
Yeah. Bob, you mentioned Ross earlier. Today, yesterday they got an upgrade. Today they held on to gains as TJ Maxx, pretty stark competitor, showed big numbers. Is what's good for TJ good for Ross, or is this going to become that margin competition game that Chris was just alluding to within these sectors?
I think currently there's room for two, but that will go away. I think Chris made a good point. At least I think it's one part of the point you were trying to make, is that as you see stores like JCPenney and Sears just completely disintegrate, some goes to Walmart, some goes to Amazon, the rest goes to these stores. So there is still a sector of consumers that they don't shop online yet.
Yeah.
And these are the beneficiaries of it, your Rosses, your Kohl's, your TJ Maxx's. And going back to Target, if I could real quick, they've done a really good job, by the way, of seeking out new young designers and saying, don't start your own fashion house, do something for us. I mean, anecdotal, I bought a great damn T-shirt there for $11. It was fantastic.
There we go. Hey, I got a cardigan out there I bought 4 years ago that's still there.
I'm sorry. I walked into the store was beautiful. The T-shirts were easy to find, and it was $11. It's quicker delivery than Amazon,
and they said,
because I got it right then.
We'll give you the deal as long as you wear our color on your pocket square on the TD Ameritrade network, right?
Always do that.
All right, guys, we got to leave it there. And on that note, Urban Outfitters trying to make an upside move. Another pretty incredible story for finding a brand and a price point that's worked for them. More on that ahead on the earnings front. Bob Iaccino is the founder and chief strategist at Path Trading Partners, and Christopher Recker is the chief investment officer at AZA Capital Management. Great to have you both here once more, and Alex Coffey as well, rounding it out for us from TD Ameritrade. Excellent work, gentlemen.